ETFs are such a great way for anybody to get started investing in the stock market. But if you make these critical ETF investing mistakes, your investments can go from complete winners to total losers. And everything that you're about to hear in this video is backed by research, math, and common sense. The number one mistake that you can make when it comes to investing in ETFs is that you ignore the expense ratio and that you focus too much on the ETF past returns. You see, there are many instances where people see an ETF that has a really good return and they go, oh, I gotta invest in that ETF. But the problem is that they don't look at the expense ratio and the cost of that ETF. But at the end of the day, if the returns are really high, but the expense ratio is also very high, then the high returns don't really matter. One of the most practical things that you can do for yourself and for your investment portfolio is to pick an S&P 500 index that has the lowest expense ratio. That way you can still get the same performance, but with a lower cost structure, your returns are going to be much higher over time. The second biggest mistake that you can make is kind of related to each other. So the first is not having an idea of the historical performance of an ETF in the past. And the second is relying on that performance as the only reason why you're investing in that ETF. The reason why the first is such a big mistake is even though they're ETFs, you really have to know what the ETF is holding, what the ETF is investing in. So that way you can have a better idea of what's likely to happen in the future and not get caught blindsided when something happens and all of a sudden the value of the ETF declines by a lot. The second mistake is over relying on the ETF historical past performance. And this is something that happened to me personally, where many years ago I got caught up in the hype, especially of Reddit, and I invested in ARK funds, but I did it when it was like such a high price. Over time, of course, that proved to not be a wise investment. Luckily, I sold my position very fast as soon as I found out that I make a mistake. But the reality is that you really need to understand how that performance was generated, and was that performance really generated because the ETF has some real merit to it, or was it also generated just because the market was really rewarding that industry, that type of companies at that particular moment of time. Now, when it comes to analyzing the historical performance of a particular ETF, one of the best ways to do that is something using a spreadsheet like the one you're seeing right now, where in this case we can see the historical performance and we can also see the expense ratio. In this way you can really compare ETFs and you can see which ones are best for you. Now this template is really cool because all you gotta do is pick an index to compare. So in this case we have the VU, which is a Vanguard S&P 500 fund, and you can add all these different ETFs or even stocks if you really want it. And so in this case, let's say that we want to add, let's say there's another fund over here. I'm just gonna pick the VU again. So if I change this to VU, this utilizes data that comes from Y-Sheets. You can see how this formulas works. Y-Sheets is an add-on that works on Excel and Google Sheets and allows you to get this particular data. And with these functions, you can build some really cool stuff. So in this case, this returns the price. From here, we can compare total return, takes into consideration the current price, the historical price, dividends that the ETF has paid, or whatnot. And in this case, you can have all of your different ETFs here, and it's gonna tell you if they're beating S&P 500 or if they're not. So in this case, you can see most of them are not beating the S&P 500. That's why they're in red. However, there's some really good ETFs right here that might be good candidates to beat the S&P 500. In this time periods, they have managed to do it. So it's very cool because it highlights this right away. Now there's all the information that you can assess, like assets under management, inception date. We already talked about the expense ratio. And if you're curious, here is how it's pulling the dividend data and the price data to complete the calculation. So this is a really cool way of being able to figure out what ETFs are best for you to invest in. The third investment mistake is investing without a clear investment strategy. You see, what oftentimes happens is that you hear someone saying, you know what, you should really be invested into this ETF because of XYZ reasons. And then unfortunately, a lot of the times we don't do our own research and we invest into those particular ETFs without really taking into account our own personal investment goals and our own personal financial situation. So before you invest in any ETFs, you really have to ask yourself, am I doing this for a short-term investment? Am I doing it for a long-term investing? Do I care more about growth than dividends, or vice versa? As well as some other questions that are really going to provide clarity as to which ETFs are the ones that you should be looking at investing in the first place. So for example, let's say that I'm retired and I have some money that I want to invest, but the reason why I want to invest this money is so that I can get some income that I can then use to fund maybe some trips, maybe some expenses, and just enhance my overall standard of living. So in that case, what would make the most sense is to pick an ETF that distributes dividends and has a low level of risk, so that way I can put my money into it, get those dividend payments, and use that money to fund what I need to be funded. And the last dividend investing mistake that you can make is to panic sell. So there are many people out there that are holding ETFs, and as soon as their stocks or the market starts to go down, all they can think about is, I really need to sell my ETFs. And don't get me wrong, that's a valid line of thinking. If, for example, you're holding some ETFs that you know are just completely risky and that are likely to go down dramatically if the market drops, that fear is completely justified. But if you're truly investing for the long run, let's say like 5-10 years from now, then to panic sell, it doesn't really make sense, especially if you're investing in ETFs that are low risk and likely to have good returns, but not right now, but instead over time in the future as those returns and those stocks continue to grow in value. In many cases, it doesn't really make sense to sell. What makes the most sense instead is to add to your position when the market goes down. We call this dollar cost averaging. So that way, overall, you're able to benefit from those times when the market drops. So that way, you're able to pick up more of those ETFs at a lower price. And then eventually, once you take that money out for your retirement or whatever reason that is, then you can really benefit from those down moments instead of them hurting you and hurting your investments. So there you go. If you avoid these ETFs investing mistakes, then your portfolio is going to do really well over time, assuming that you just pick the right ETFs for your particular situation. If you've enjoyed this video, make sure to subscribe to the channel, and I'll see you in the next one.